Hey everyone! Today we're diving into the exciting world of margin trading. It's like adding rocket fuel to your portfolio, but with a catch. Imagine amplifying your gains. That's the power of margin trading. It lets you borrow money to buy more stock. But hold on, every powerful tool comes with risks. Margin trading can magnify your losses. That's the peril. So buckle up and let's explore the world of margin trading. What is margin trading? It's borrowing money from your brokerage firm to buy stocks. Think of it as a loan using your investments as collateral. You can buy more stock than you could with just your own money. This is leverage. Leverage amplifies both gains and losses. Control a larger position with less capital. But remember, it magnifies losses too. If the stock price goes up, your gains are magnified. But if it goes down, your losses are also amplified. Leverage is a double-edged sword. Let's break down what margin trading really means. It's a partnership with your broker, where they lend you money to buy more stock. Brokers require you to put up a portion of the purchase price, known as the initial margin. The remaining amount is covered by your broker, giving you extra buying power. You'll pay interest on the borrowed funds. Margin trading allows you to control more stock with less capital. But remember, it can also amplify your losses. Let's say you've got your eye on a stock company XYZ. Each share is priced at $100. You have $5,000 to invest. With regular trading, you could buy 50 shares. But with margin, you can borrow 50%. You put down $2,500 and borrow the rest from your broker. Now you control $5,000 worth of stock. If the stock price rises, your profits are amplified. But if it drops, your losses are also amplified. Understanding leverage, the double-edged sword. This amplification of both profits and losses is the essence of leverage, the ability to control a larger position with a smaller initial investment. It's like using a lever to lift a heavy object. A small amount of force applied at one end can move a much larger weight at the other. In margin trading, your own money is the force, and the borrowed funds act as the lever, magnifying your potential gains or losses. While leverage can be an attractive tool for experienced traders, it's crucial to approach it with caution. The higher the leverage, the greater the potential for both rewards and risks. Think of it as walking a tightrope. Margin trading can offer exhilarating profits if you maintain your balance, but even a slight misstep can lead to significant losses. Now let's dive deeper into how margin works. We've touched upon initial margin, which is the upfront payment you make when opening a margin position. Think of it as your skin in the game, showing the broker you're serious about this investment. But the plot thickens. There's another crucial player in the margin game, the maintenance margin. The maintenance margin is like a safety net for your broker. It's the minimum amount of equity, your own money in the account, that you need to maintain at all times. This ensures you have enough cushion to cover potential losses. Imagine it as a buffer zone protecting your broker's loan. Typically, maintenance margins are lower than initial margins, often around 25%, but this can vary depending on the broker, the specific security and volatility you're trading. Why is this important? Because if the value of your investments dips and your equity falls below this maintenance margin, alarm bells start ringing. Remember that friendly loan your broker gave you to boost your buying power? Well, just like any loan, it comes with a price tag: interest payments. That's right, you'll be paying interest on the borrowed funds for as long as you hold the margin position. Think of it as a rental fee for using the broker's money. The interest rates can vary, just like with any loan, depending on your broker, the amount you borrow, and prevailing market rates. It's like renting a swanky car. The more luxurious the ride, or the larger your loan, the higher the rental fee. Now, this interest can eat into your profits, especially if you hold your margin position for an extended period. Imagine holding that margin loan for months or even years. Those interest payments can add up and shrink your overall returns. It's like a slow leak in your tire. It might not seem like much at first, but over time it can cause significant deflation. Navigating the water's maintenance margin in action. Let's say you've bought $10,000 worth of that hot stock, company XYZ, using $5,000 of your own money and $5,000 borrowed from your broker. You're feeling good, riding the wave of potential profits, but suddenly, the market takes a dip, and company XYZ's share price drops by 10%. Now, your $10,000 investment is worth only $9,000. You've lost $1,000, but here's the kicker. You still owe your broker the $5,000 you borrowed. This means your equity, your own money in the game, has shrunk to $4,000. Remember that safety net, the maintenance margin? If your broker has set a 25% maintenance margin requirement, you need to maintain at least $2,500 in equity. You're still above water with $4,000, but the waves are getting choppy. Market volatility, the tide that can turn. Now imagine the market takes another tumble, and company XYZ's share price plunges further, this time by 20% from its original price. Your $10,000 investment is now worth only $8,000. Your equity has taken a nosedive, plummeting to $3,000. Here's where the danger zone begins. Remember that 25% maintenance margin requirement? You're now precariously close to falling below that critical threshold. Your broker starts to get nervous because their loan is looking a bit shaky. This is the perilous nature of market volatility, especially when you're leveraged with margin. It can quickly erode your equity, putting you at risk of a margin call, which is essentially your broker tapping you on the shoulder saying, "Hey, we need more money." Understanding margin calls. A margin call is a signal from your broker that your equity has fallen below the required maintenance margin. It's like a lifeguard waving you back to shore because you're venturing too far into dangerous waters. You can deposit more money or sell some investments to meet the margin call. Ignoring a margin call is not an option. If you fail to meet it, your broker can sell your investments to cover the borrowed funds. Remember that sinking feeling when you realize you might have overspent on your credit card? A margin call is like that, but in the world of investing, it's your broker sending you a not-so-subtle message. Hey, your investments aren't looking so hot, and we need more collateral to cover that loan we gave you. Imagine it as a financial tap on the shoulder, reminding you that margin trading comes with strings attached. Those strings tighten when your investments decline in value, putting your broker's loan at risk. They want to make sure they can recover their money, even if your investments go south. A margin call isn't a suggestion, it's a demand. You need to act fast to rectify the situation, either by depositing more funds or selling some of your investments to reduce the loan amount. Ignoring a margin call is like ignoring a flat tire. It won't fix itself and could lead to a bigger mess down the road. So, you've received a margin call. Now what? You have two primary options. Deposit more funds into your account or sell some of your investments. It's like being asked to choose between adding more logs to the fire or throwing some water on it to bring the temperature down. Depositing funds is like adding fuel to the fire. It increases your equity, pushing you back above the maintenance margin requirement and satisfying your broker. But be cautious. Depositing more money might seem like a tempting solution, especially if you believe the market will rebound, but it also means increasing your exposure and risk if the market continues to decline. Selling some of your investments is like throwing water on the fire. It reduces your loan amount, bringing your equity back in line with the maintenance margin. However, selling under pressure might mean realizing losses, especially if the market is in a downturn. It's like selling your prized possessions at a garage sale because you need cash quickly. Imagine walking a tightrope suspended above the ground. The tightrope represents your equity in a margin account, and the ground symbolizes the maintenance margin requirement. As long as you stay balanced on the tightrope, your margin position remains secure. However, market fluctuations can cause the tightrope to sway, making it challenging to maintain your balance. When your investments perform well, the tightrope feels sturdy, and you can confidently stride forward. But when the market takes a downturn, the tightrope begins to wobble, and you need to adjust your footing to avoid falling below the maintenance margin. This constant need to monitor your equity and make adjustments is the delicate dance of margin trading. It requires vigilance, discipline, and a willingness to make tough decisions, especially when the market throws unexpected punches. Market volatility, the margin call catalyst. Think of market volatility as the mischievous gremlin that loves to shake the tightrope while you're walking it. The more volatile the market, the more unpredictable the swings in your equity, increasing the likelihood of receiving a margin call. Imagine you're sailing in calm waters, enjoying the steady breeze and the gentle rocking of the boat. Suddenly a storm erupts, bringing choppy waves and strong winds. That's market volatility in action. It can turn a peaceful trading experience into a white-knuckle ride, especially when you're leveraged with margin. Volatility can quickly erode your equity, pushing you closer to the dreaded margin call. It's like driving on a winding mountain road. You need to stay alert, anticipate sharp turns, and be prepared to adjust your course to avoid going over the edge. Protecting yourself. Strategies to avoid margin calls. While margin calls can be stressful, they're not inevitable. Just like a seasoned sailor prepares for storms, you can implement strategies to weather the volatile seas of margin trading and reduce the risk of receiving those dreaded calls. One crucial strategy is setting stop-loss orders. These are like safety nets that automatically sell your investments if their price drops to a certain level, limiting your potential losses. Think of it as setting a safety valve on a pressure cooker. It releases excess pressure before it builds up and causes a catastrophic explosion. Another important strategy is maintaining a healthy margin level. Avoid maxing out your borrowing capacity. Instead, keep a buffer in your account to absorb potential losses without triggering a margin call. It's like leaving some wiggle room in your budget. It provides a cushion to handle unexpected expenses without derailing your finances. Anatomy of a margin call, a step-by-step breakdown. Imagine you're an investor named Sarah, eyeing a promising tech stock, Technova, trading at $50 per share. You have $5,000 and decide to leverage your investment using margin, buying 200 shares for $10,000. You use your $5,000 and borrow the remaining $5,000 from your broker to complete the purchase. Riding the roller coaster market, volatility strikes. Initially, things are looking good. Technova's share price climbs, but then the market dips, dropping Technova to $45 per share. Your 200 shares are now worth $9,000, and your equity shrinks to $4,000. Your broker's 25% maintenance margin requires at least $2,500 in equity. For now, you're still above water with $4,000 in equity, but the waters are getting choppy. The margin call arrives. Time for action. The market downturn continues, and Technova's share price plummets to $40 per share. Your 200 shares are now worth $8,000, and your equity drops to $3,000. You're close to falling below the 25% maintenance margin requirement. Your broker sends you a margin call, a financial wake-up call, reminding you that your leveraged position is at risk. The dark side of margin-amplified losses. Margin trading can magnify profits, but it also amplifies losses. Sarah's 20% drop in Technova's share price didn't just wipe out potential profits, it amplified her losses because of the margin loan. The faster you try to accelerate your gains with leverage, the harder it becomes to hit the brakes when things go wrong. Navigating the minefield, margin calls and liquidation. Ignoring a margin call is risky. If the market continues to move against you, you risk triggering a forced liquidation. Liquidation is the broker's last resort to protect their loan, selling off your assets even at a loss. It's like being forced to sell your house at a bargain price because you couldn't keep up with the mortgage payments. The interest rate time bomb, a silent profit eater. Interest payments on margin loans can accumulate and significantly eat into your returns over time. The longer you hold a margin position, the more interest you accrue, diminishing your overall gains. This is especially critical if you're using margin for long-term investments. Volatility and margin, a risky tango. Market volatility can create opportunities for quick profits but also amplify losses with breathtaking speed. Sudden market swings can erode your equity faster than you can say margin call, forcing you to scramble for additional funds or risk liquidation. Volatility is a double-edged sword for margin traders, creating opportunities and risks. Now let's talk about the exciting part of margin trading, the potential for amplified gains. Margin trading allows you to control a larger position in the market with a smaller amount of your own capital, magnifying your potential gains. If you buy a stock that goes up 10%, using margin can double your return to 20%. It's like doubling your money's growth potential. Imagine you're a kid in a candy store with a limited allowance. Margin trading boosts your spending power, allowing you to buy more stocks. This can be beneficial for investors bullish on specific stocks or sectors, but with limited funds. With margin, you can purchase a larger stake in a stock, potentially amplifying your profits if your prediction proves correct. Imagine you're a surfer waiting for the perfect wave. Margin trading can be like catching that wave at its peak, allowing you to ride it for a short but potentially profitable ride. For experienced traders, margin can be a valuable tool for capitalizing on short-term market movements. However, short-term trading with margin requires skill and agility to navigate the ups and downs. Margin, not for the faint of heart. Margin trading offers amplified gains but comes with increased risk. It requires experience, discipline, and a solid understanding of the risks involved. Before diving into margin trading, assess your risk tolerance, investment goals, and financial situation. Margin trading, not for everyone. Margin trading isn't for every investor. It requires nerves of steel and a willingness to embrace risk. If you're new to investing or have a low risk tolerance, margin trading is not for you. Margin trading is also unsuitable for long-term investments due to accumulating interest payments. If you're considering margin trading, it's crucial to have a solid risk management plan in place. Never borrow more than you can afford to lose, and diversify your investments to reduce exposure. Think of it as your safety net, protecting you from the potential pitfalls of leveraged investing. Spread your investments across different asset classes, sectors, and industries. Setting limits is like installing guardrails on a winding mountain road. Determine your maximum margin level and stick to it, regularly monitoring your margin account. Keep a close eye on your equity levels, interest payments, and any margin calls you receive. Early detection is key to mitigating potential losses. Imagine having a guardian angel watching over your investments. Stop-loss orders act as automated risk managers, limiting your potential losses. They provide a safety cushion, preventing your losses from spiraling out of control. By setting stop-loss orders, you're creating a safety net that limits your downside risk. There you have it, folks. We've journeyed through the exciting and sometimes daunting world of margin trading. Margin trading can be a powerful tool for amplifying gains, but it requires knowledge, discipline, and respect for the risks involved. Address margin calls head-on and never ignore the importance of risk management. If you're willing to put in the work and approach it with caution, margin trading might just be your ticket to an exciting and potentially profitable journey in the financial market.